Welcome to the Deep Dive, where we take the densest source material, filter out the noise, and deliver the essential insights you need to stay ahead of the curve. Today, we are staring down a crisis of physics and bandwidth right at the very heart of the AI supercycle. For decades, the tech industry operated under this doctrine of Moore's Law. You just make transistors smaller and computation gets faster. Simple.
Yeah, but we've hit a profound wall, a really hard wall.
We have. The modern AI model, running on tens of thousands of GPUs, is so computationally intensive that the resulting tsunami of data, the sheer movement of information between chips, it's literally fighting back against the supercycle itself.
It's the ultimate paradox of modern computing, isn't it?
Sure.
We have these incredibly powerful processing units from NVIDIA or AMD, but they are just starving for data. The bottleneck is no longer the processing speed.
It's communication speed.
Exactly, it's communication speed. We are still relying on, well, basically ancient technology, copper wires, electrical signals, to move these massive streams of data, and the physics simply does not comply anymore.
Copper is just too hot, it's too heavy, and it's way too slow once you start pushing past 800 gigabits per second. For the huge, hungry, large language models that are supposed to define the future of AI, the heat and the power consumption from these electrical interconnects it's just prohibitive.
So the switch from electrons to photons, from copper to light, it's not optional.
No, it's mandatory.
It's absolutely mandatory. And, the solution itself, optical interconnects, that's been known for 40 years. But the transition has always been defeated by one thing.
Manufacturing complexity.
Manufacturing complexity. No one could figure out how to mass-produce optical chips as cheaply and as reliably as we make standard silicon.
Well, the sources we've analyzed today point to a small, Toronto-headquartered semiconductor design company that claims to have cracked that 40-year-old manufacturing code. They say they've solved the optical transition just as these trillion-dollar giants like NVIDIA, Broadcom, and Marvell are desperately needing a solution.
And that company is PoE Technologies.
Exactly. So our mission today is to dive deep into the comprehensive source material surrounding POET, currently trading at $4.68, to understand the massive commercial opportunity presented by their proprietary technology. And, just as important, the very significant execution risks that are inherent in scaling a deep tech solution in such a capital-intensive industry.
And we have to start right away with the event that fundamentally altered the market's perception of them.
The big news.
The big news. On December 3, 2025, POET stock experienced a huge 16% intraday surge. And that surge was driven by the news that Marvell Technology acquired POET's critical partner, Celestial AI.
And that validation event is so crucial because it's not just a commercial win, it's strategic validation. Marvell, one of the most respected semiconductor giants in the industry, just spent a ton of capital to acquire a company whose core technology relies on POET's light source.
It validates their entire technological ecosystem. It potentially inserts them directly into Marvell's high-speed optical supply chain. It's a game changer.
And when you look at the balance sheet context, the valuation anomaly, it just jumps out at you immediately. POET is a company with a current market cap of around $617 million, yet they have a projected cash position of $300 million just sitting on the books after their recent financing.
Nearly half their market cap is liquid cash.
It's an absurd setup. The market is currently valuing their entire operating business, the IP, the partnerships, the talent, the initial production orders, at just around $317 million.
And you have to ask why. It's because of years of skepticism and, let's be honest, execution delays. But that very anomaly gives the learner, a substantial margin of safety.
So today, we will reveal exactly how low that current price sits compared to the intrinsic value range. We found that the current price is aligned with the lower end of our base case, which suggests the market is providing a kind of free option on the ultimate bull case scenario.
And that bull case, in the event of widespread adoption, could reach as high as $12 per share.
It's an intriguing setup where the execution risk is definitely priced in, but the existential risk, the risk of them going out of business, that's gone. Let's unpack the details.
Part 1, Chapters 1 to 3, Business, Management, and Financials.
Chapter 1, Business Understanding.
Okay, so the core of the thesis really starts with the physics problem they're solving.
Right, let's elaborate on this physical impasse. We know the industry has to switch to photons, to light for communication, but why has this been so incredibly difficult for so long?
The difficulty lies in the manufacturing. It's a process called active alignment. Now, imagine trying to guide a microscopic beam of light from an extremely tiny, very expensive laser chip into an even tinier, fragile glass fiber.
Okay.
You have to do this with mechanical tools. You power on the laser, you measure the light output with, submicron precision, and then while it's still running, you have to mechanically glue or solder all the components into place.
That's the Swiss watch by hand analogy we saw repeated in the sources. It just sounds slow.
It's incredibly slow. It's a serial process, one module at a time. It's expensive, it requires highly skilled labor, uses exotic materials, and it is absolutely impossible to scale to the millions of units that a Google or a Meta demands every year.
Right. It's why optics have always been so capital intensive.
Exactly. Now, POET's solution, the optical interposer, is a fundamental manufacturing breakthrough that solves this with something called passive alignment.
Okay, so what is passive alignment?
Think of the interposer as a highly advanced circuit board, but for light and electricity, printed directly onto a standard silicon chip. This proprietary platform has microscopic guides and stops etched right into the silicon itself.
And here's the genius part, right? Because the alignment structure is built into the silicon architecture, they can use standard, high-speed, automated pick-and-place equipment.
The same inexpensive tools used everywhere in semiconductor manufacturing.
Right, to just drop the lasers, the detectors, the drivers, everything onto the chip. And the chip itself does the alignment automatically.
Precisely. This is what they call the semiconductorization of photonics. It completely abandons those bespoke hand assembly processes and replaces them with standard, high-volume silicon manufacturing techniques. The sources describe it perfectly. The assembly process becomes as automated, scalable, and cost-effective as printing a newspaper.
That's scalability. That changes the entire cost structure of optical components.
It changes everything.
I find the Switzerland and Photonics analogy really fascinating. Let's talk about their market position and business model.
That analogy fits perfectly because POET is device agnostic. They are not vertically integrated like some of the incumbents who are, forced to use their own lasers, whether they're the best or not.
Okay.
POET sources the best, the highest performing components, lasers from partners like Lumentum or Mitsubishi, and integrates them onto their interposer. They don't have to bet on which specific laser company wins the race. They just buy the winner and integrate it.
Which diversifies their supply chain risk significantly.
Hugely. And this technological moat supports their three-pronged, or as they call it, trifurcated revenue model.
Okay, so let's break that down. What's the first prong?
First is the primary growth engine, optical engine sales. They sell complete, tested, ready-to-use chiplets to module manufacturers, big ones like Luxshare and Foxconn.
And those partners get to bypass the really complex yield-killing alignment process entirely. They just drop the POET engine into their final transceiver product.
Exactly. It's a massive value proposition for them. Second is non-recurring engineering, or NRE.
These are the upfront customization fees.
Right. It's what they charge partners for specific designs.
Yeah.
A prime example is the significant NRE revenue they got from developing the Starlight external light source for Celestial AI.
And that cash is essential because it funds their continuous R&D, and critically, it creates these sticky relationships. I mean, once a customer finances a custom product, they're highly motivated to buy it in volume.
Absolutely. And the third prong, the high-margin long-term vision, is licensing and royalties.
This is the end game.
This is the end game. Once the technology is fully proven at scale, the idea is to license the optical interposer IP itself to major foundries all over the world. This would create a stream of high-margin, volume-based royalties based on every single wafer processed using their techniques.
Which would make them the air arm of Photonics. We'll definitely come back to that.
For sure.
Okay, let's look at the products that are actually supporting this model right now. The flagship solution is POET Infinity. This targets the massive, standardized, pluggable Ethernet market.
Right. This is the standardized market for high-speed transceivers that connect racks within data centers. It supports 400G, 800G, and the absolutely critical emerging 1.6T standards.
And the pluggable part is key here, isn't it?
It's very key because it means the product conforms to industry standards. That makes adoption easy for hyperscalers like Amazon or Microsoft, who prioritize standardization above almost everything else.
But the real explosive potential for the AI supercycle, that lies in POET Starlight. This addresses that profound problem of co-packaged optics, or CPO.
The CPO challenge is actually pretty simple to understand. GPUs, especially these massive AI chips, are volcanically hot.
Right.
And lasers absolutely fail when they're exposed to that much heat. So if you package the laser directly next to the GPU, you kill the reliability of the whole system.
So Starlight is their elegant solution, an external light source, or ELS?
Exactly. It acts as a remote power plant of light. It delivers the necessary laser power through optical fibers from a safe, cool distance away from that hot GPU.
And that partnership with Celestial AI, who are now, of course, acquired by Marvell for Starlight development, is precisely why that December 3rd news was so transformative. It directly links PO8's tech to the bleeding edge of AI infrastructure.
And we also need to highlight the necessary technical acceleration into 1.6T. Their collaboration with Semtech integrates the TIAs directly onto the interposer.
Okay, stop there. The TIA. For the learner, what is the job of the transimpedance amplifier, and why is integrating it so crucial at these 1.6T speeds?
Sure. So the TIA is the crucial component that catches the incoming photon, the light signal, and converts it back into an electrical signal that the chip can understand.
Okay.
Now, if that TIA is too far away from the photodetector, the resulting electrical signal degrades almost instantly at 1.6 terabits per second. Every single micron of copper wire degrades performance.
So you have to get them as close as possible.
You have to. Getting the electrical components, the TIA, closer to the optical engine is mandatory to preserve that signal integrity and hit those speeds reliably. POET's density advantage is what makes this integration possible.
Speaking of density, let's discuss their primary value proposition. This is what convinces hyperscalers to switch. It boils down to three things: cost, size, and thermal efficiency.
Starting with cost, that switch from serial manual alignment to parallel automated wafer-level packaging. That allows them to claim a total cost reduction of 25% to 40% for their optical engines compared to traditional methods.
And when you're buying millions of these things, a 25% saving it's a competitive weapon.
It's a huge deal. Then there's miniaturization. Space in the data center is precious, and for 1.6T and 3.2 modules, component density is the absolute constraint.
And management highlighted this brilliantly. They said 3 of their optical chips can fit across the face of a dime.
Right. That level of miniaturization is non-negotiable for future scaling.
And finally, thermal efficiency. This ties directly back to that AI energy crisis we talked about.
It does. By eliminating wire bonds, those tiny copper connections that introduce resistance and heat and integrating components directly, they reduce power consumption substantially. Less power consumption equals less heat and lower operational cost.
Which is vital for sustainable AI scaling.
Absolutely.
This all moves us from what was a science project phase to a real commercial inflection point. For over a decade, PO8 was pre-revenue, but 2025 has clearly marked a transition to commercial supplier status.
And it's evidenced by those 2 successive initial production orders, valued at over $5.6 million in Q3 of 2025.
That $5.6 million is absolutely the most critical operational data point we have. It represents a 10x to 20x increase over their entire historical annual revenues. This is the moment the theoretical revenue hockey stick officially starts to bend upward.
It is. And to meet this demand, they are leveraging a fab-lite model, partnering with assembly and test specialists in Malaysia, specifically Nationgate and Globetronics.
So what does their capacity target look like with these partners?
Their current projections point to an assembly and test capacity exceeding 1 million optical engines per year once the facility is fully ramped.
Wow.
And based on current market prices for 800G and 1.6T engines, that capacity represents hundreds of millions of dollars in potential revenue. It provides a clear path to scale far beyond their current small cap valuation.
The market they are addressing is just huge. The AI infrastructure supercycle is driving this explosion of what they call east-west traffic, which is server-to-server communication. The transition from 400G and 800G to 1.6T interconnects means this whole silicon photonics market is exploding.
It really is. The global silicon photonics market is projected to grow from roughly $3 billion in 2025 to somewhere between $10 and $12 billion by 2030. That's a compound annual growth rate of over 27%, and it's entirely dependent on high-speed optics that copper just cannot handle.
And PO8 is positioned directly at the geometric center of that growth.
Right in the middle of it.
Okay, but let's be brutally honest here. What is actually stopping the giants, a Broadcom, a Coherent, from simply copying this approach in 2 years? Where is the real moat?
That is the right question to ask. The incumbents are kind of the Toyota of the optical world. They have massive scale, massive market share, but they're hitting a wall with their traditional active alignment methods. They're hitting hard limits on cost and yield at 1.6T.
And what about the other major effort? Monolithic silicon photonics from giants like Intel or Cisco.
Right, so Intel has poured billions into trying to perfect monolithic integration, building the laser directly onto the silicon chip. But silicon doesn't naturally emit light efficiently.
It's a fundamental physics problem.
It's an incredibly difficult physics problem that leads to major yield issues. POET just bypasses that entire challenge with their hybrid approach, leveraging the existing silicon ecosystem for the structure while using proven, reliable, separate lasers.
So the sources clarify that the moat is really rooted in deep material science, not just software IP.
Yes, the material science moat is formidable. It took POET 5 years of iterative failure to solve the problem of matching the coefficient of thermal expansion, or CTE, between all the different materials.
So what does that mean in simple terms?
When materials heat up, and these chips get very hot, they expand. If the silicon, the polymer waveguides, and the laser chips all expand at different rates, the ultra-precise optical alignment is instantly ruined. Getting that recipe for thermal stability right is proprietary and incredibly difficult to replicate.
And then there is the barrier of qualification cycles.
This is a huge competitive advantage. Before a hyperscaler buys a single transceiver, they demand thousands of hours of reliability data, often over 3 years, proving that the module will not fail in a hot data center environment.
And POET has already done this work.
They've done the work. A new entrant would have to start that entire testing process from scratch, which provides POET with a significant time-to-market advantage. It could potentially lock out competition for years.
So the optical interposer is the singular unique asset. It transforms POET from just another component provider into a strategic technology partner. And once they secure a design win, the switching costs are formidable.
Absolutely. Once a customer integrates the POET engine, switching to a competitor would mean a complete redesign of the transceiver circuit board, its thermal management solution, and its firmware.
That's a massive rip-and-replace cycle taking 12 to 18 months.
And in the fast-moving AI hardware market, that kind of delay is simply unacceptable. Once POET is designed in, they are extremely sticky.
That is a phenomenal analysis of the technology and the market positioning. Before we move on to the management team that navigated this difficult pivot, we do need to take a quick moment.
Like and subscribe to stockanalytics.ai YouTube channel.
Remember, members can add stock suggestions for future videos in the comments, and we will pick them up. Okay, let's unpack the management team that not only guided the company through a decade of pre-revenue struggle, but also managed a massive technological pivot.
Chapter 2.
Management evaluation. To understand POET's current trajectory, you really have to understand the architect of that hard pivot, Dr. Suresh Venkatesan, the CEO. His background is not in photonics research, but in high-volume, high-stakes semiconductor manufacturing.
And that background is absolutely critical to the story. He was a senior vice president of technology development at Global Foundries. He was responsible for ramping up incredibly complex manufacturing processes like the 14-millimeter node and scaling the 28-millimeter business to over $2 billion in revenue.
So he has a track record of operational excellence on an enormous scale.
A proven one. And that operational mindset drove his most important decision, the hard pivot around 2015. When he arrived, POET was pursuing a monolithic gallium arsenide approach. It was scientifically elegant, but commercially unviable, because there was no manufacturing ecosystem for it.
He recognized that for photonics to achieve scale, it had to abandon that path and switch to the silicon optical interposer, leveraging the existing, proven, trillion-dollar silicon ecosystem.
It demonstrates a very rare trait in deep tech CEOs, prioritizing commercial viability and mass scalability over just scientific novelty. He successfully executed a company reset, which it basically saved them.
Complementing his technical vision is Thomas Mika, the CFO. He was the financial navigator who had to manage a decade of relentless R&D cash burn. His major test came in mid-2024 during a liquidity squeeze that led to a going concern warning in their financials.
And he responded decisively. He successfully engineered a massive aggregate $250 million financing package in late 2025. That strategic move completely secured the company's financial future, eliminated the existential risk that had plagued the stock for years, and it opened the door for institutional capital to finally come in.
But wait, we have to pause here. If they missed their 2022 and 2023 roadmaps, and the stock is still trading near the bottom of the base case, isn't the market signaling that it doesn't trust this management team's ability to execute this hockey stick growth? Why should we believe them now?
That's the execution ghost that they have to constantly fight. And it's a completely fair critique. The historical credibility gap is real. However, the sources show a palpable shift in their communication in 2025. They've transitioned from, aspirational timelines to precise, verifiable communication.
You mean things like announcing specific order values?
Exactly. They announced the specific actual value of the production orders, $5.6 million. And they immediately disclosed the material impact of the Marvel Celestial AI acquisition on December 3rd. That level of transparency and precision is a measurable improvement in their investor relations strategy. It signals maturity just as they are transitioning into mass production.
Let's discuss the new capital allocation strategy then. They are no longer focused on survival. They're focused on conquest. They have a formidable $300 million war chest. How is this money being deployed aggressively?
Well, first, a significant portion is going toward manufacturing capex. While they are fab-light, they still need to purchase and own the specialized bonding and testing equipment that goes into their Malaysian partner facilities, NationGate and Globetronics, to hit that 1 million unit annual capacity target.
So this guarantees them control over quality and stealing.
It does. Second is R&D acceleration. They cannot afford to rest on the current interposer technology. Investment is being poured into the 1.6T and 3.2T roadmaps to stay 2 generations ahead of the market. They're investing today to secure design wins 5 years from now.
And third, they've signaled clear M&A intent.
That's right. Management explicitly stated they will pursue inorganic growth through acquisitions. This means they are likely looking to acquire specialized IP blocks or component makers to vertically integrate high-value pieces of the module, which would let them capture more margin per unit sold.
Regarding shareholder returns, it's important to confirm for the learner that this is a quintessential growth stock. There is no history of share buybacks or dividends. The only mechanism for return is capital appreciation tied to successful execution.
And we must acknowledge that the traditional financial metrics for a company like this look terrible on paper. GAAP return on invested capital, ROIC, is deeply negative. But that's all backward looking.
So a better metric to gauge their operational efficiency is the revenue potential per CapEx dollar.
Precisely. Because they use that fab-light model, they avoid the multi-billion-dollar costs of building a foundry. They can unlock hundreds of millions in potential revenue with only tens of millions in specialized capex.
Not billions.
Not billions. This incredible operating leverage suggests that once that revenue ramp begins, successful execution of those $5.6 million in orders, the incremental ROIC, the return on each new dollar they invest in manufacturing, will be extremely high. That's really the key to the bull case valuation.
That sets us up perfectly for the balance sheet and that valuation anomaly we mentioned.
Chapter 3, Financial Health.
Let's start with the current context. As of the analysis date, the market capitalization is $617 million USD. And we really cannot stress this valuation anomaly enough. $300 million of that market cap, nearly 50%, is liquid cash.
It's astonishing. It really is, especially when you consider that dozens of AI hardware startups with zero revenue and unproven tech demand, multi-billion-dollar valuations in the private markets. The market is valuing POET's patented, validated IP, its strategic partnerships with Marvell, and its initial order book at barely $317 million.
And this valuation gap is a direct reflection of that historical execution skepticism.
It is. It sounds absurd, but let's be fair. That low valuation is actually a direct result of their own historical actions. They burned cash and missed timelines for years. So doesn't that historical execution ghost completely justify the low price until they can prove they can ship millions of units?
It absolutely justifies the price, but it simultaneously creates the opportunity. The market is saying, we only believe you can execute the base case, and we are going to discount everything else because of historical risk.
And that's where the value is.
Let's look at the revenue inflection point. Historical revenue has been volatile, hitting a trough of just $41,000 in 2024. But the trailing 12-month revenue is now up to $762,000.
And that sharp turn began in Q3 2025, which saw $298,000 in revenue alone. That's an 8,000% increase year over year.
But the truly significant forward-looking data point is the announcement of the $5.6 million in initial production orders.
That one announcement, which is expected to be fulfilled over the next 12 to 18 months, represents a 10x to 20x increase over their entire historical annual performance. The hypergrowth phase isn't a projection anymore. It has a dollar value attached to it.
Okay, what about margins and the burn rate?
The target gross margin is expected to stabilize around 50%, plus once yields stabilize at their Malaysian facility. That's a very healthy margin, typical for high-value semiconductor IP.
Okay.
However, they are still deeply negative on the operating side. Operating expenses R&D plus SG&A are high, running about $9.85 million per quarter.
Which means the operations are consuming serious cash every quarter.
Correct. The operational cash burn typically runs between $3 million and $8 million per quarter, although, improved fiscal discipline saw the Q3 2025 burn reduced to a healthier negative $2.8 million.
But given the $300 million cash fortress, they have secured a runway of 3 to 4 years without needing any external capital.
Which removes the #1 risk for small-cap technology companies.
Exactly.
Let's look at that financial stability. They have no significant long-term commercial debt. And with $300 million in cash versus roughly $40 million in current liabilities, the current ratio is a formidable 7.5x.
The going concern risk from 2024 is completely totally eliminated. They are now fiscally sound enough to endure execution delays, weather economic downturns, and fund their aggressive expansion plans.
Okay, so since they have virtually no earnings history, we can't use PE, and price to sales is distorted by the rapid revenue acceleration. So valuation has to rely on projecting the future.
We have to use a discounted cash flow or DCF model. This means we have to project the cash flows they might generate if they successfully capture the AI optical market over the next decade, and then we discount those volatile future dollars back to today's value.
And what were the key assumptions driving the DCF model?
Due to the inherent small cap nature and the execution volatility, we used a high discount rate, or WACC, of 10 to 12%. The terminal growth rate, assuming long-term growth in line with data traffic, was set pretty conservatively at 3%.
And here are the calculated intrinsic value ranges, which represent the payoff of this whole analysis.
So in the base case, this assumes a successful ramp based on the current orders. POET executes their pluggable Ethernet commitments and grows conservatively to, say, $250 million in annual revenue by 2030, capturing a modest 2-3% of the serviceable market.
Okay.
In this scenario, the intrinsic value range is $4.85 to $5.50 per share.
Which is fascinating because the current price of $4.68 is sitting right at the lower end of that base case. The market is pricing in just the successful execution of their already announced plan.
Exactly. But now, the ultimate upside is the bull case, the AI supercycle. This assumes their external light source, Starlight, becomes the de facto standard for Marvel celestial AI and gains widespread adoption in 1.6T transceivers. That would push revenue past $500 million by 2030.
And in that scenario,
the intrinsic value leaps to $8 to $12 per share.
So the thesis is that the market is providing a margin of safety via the cash position, essentially valuing the operating business at its minimum viable success and offering the massive upside potential of the AI supercycle for free.
It's a high beta setup where the risk has shifted entirely from financial solvency to operational execution.
That is a compelling structural setup. We're going to pause here before moving into part 2, where we cover market sentiment, the geopolitical risks, and our final investment conclusion.
Like and subscribe to Stock Analytics AI.
For $4.99 month, get 500 plus deep dive videos on all S&P 500 stocks with NASDAQ 100 coming next, plus members only requested deep dives.
Part 2, Chapters 4 to 7, Market Sentiment, Ownership, Risk, and Final Conclusion.
Chapter 4, Market Sentiment.
So sentiment among the boutique analyst firms that cover POA is uniformly bullish. The consensus rating is a strong buy, with an average price target of $6.77, which represents about a 45% upside from the current price of $4.68.
And that December 3rd news flare had an immediate and measurable impact on that consensus. Northland Securities, for example, immediately reiterated their outperform rating and raised their price target from $7 to $8.
And this was specifically because the Marvel Celestial AI acquisition fundamentally de-risked POET's key AI technology play.
That one event drove the 15.8% intraday rally. It fundamentally shifted the narrative from, speculative startup trying to enter the market to
strategic supply chain partner for one of the largest, most sophisticated semiconductor companies in the world. It's a massive psychological validation for the broader market.
Let's look at the short interest, though. Even with this validation, the stock is still a battleground.
It is. Current short interest sits at approximately 9.39% of the float. That represents about 12.3 million shares held by bears betting against the company.
But the trend is positive.
The trend is positive. Short interest has decreased by about 45% recently, which indicates that the short sellers are retreating as the company secures financing and proves it can deliver on those initial orders.
And that retreat creates the potential for a short squeeze if the execution continues successfully.
Yeah, the days to cover ratio is around 2.2. This means any sustained positive volume surge driven by, say, a major contract announcement can force those shorts to cover their positions rapidly, which would just exacerbate the upward price move.
And technically, the stock is showing some strong bullish signals. The current price of $4.68 is trading comfortably above the 50-day moving average, which is around $4.25.
More significantly, it recently surged past its 200-day moving average. Crossing that 200-day line confirms a long-term trend reversal. It can potentially trigger algorithmic buying known as a golden cross, signaling to the larger technical investing community that the stock has moved decisively from a bearish to a bullish trajectory.
Chapter 5. Ownership Structure.
So the shareholder registry is currently undergoing a highly desirable rotation. We are seeing a shift away from short-term retail speculators who held the stock during the cash burn phase toward more sophisticated institutional capital.
And that is a crucial quality upgrade in the shareholder base.
A huge upgrade.
So can you highlight the role of these significant institutional players here?
Sure. Sophisticated funds that specialize in special situations like MMCF International now hold approximately 16% of the company. That's about 17 million shares. They participated heavily in that large October 2025 financing.
And their continued massive stake suggests a deep conviction that the stock is undervalued based on long-term fundamentals, not just short-term trading.
Exactly. And the sources noted that the latest raise was subscribed by 2 new fundamental investment managers.
What does that signify?
It signals stability. Fundamental investment managers focus on intrinsic value and are much less likely to liquidate during routine market volatility. This influx of high-quality capital provides stability and a stronger institutional foundation for their next stage of growth.
Insider alignment is also strong, which is always reassuring for the learner.
Absolutely. Management has maintained significant equity positions, which aligns their financial interests directly with shareholder returns. CEO Venkatesen holds over 325,000 shares, and CFO Mika holds over 200,000 shares.
And crucially, they have demonstrated a holding pattern. No significant insider selling during the recent price spikes.
Right, which suggests they believe the long-term potential far outweighs the current valuation.
But we have to address the risk and benefit of ownership concentration.
It's a double-edged sword. With the top 5 to 10 funds controlling 20% to 30% of the float, this concentration can create a strong price floor because these institutions are long-term holders.
But
If one of them decides to exit for whatever reason, it can create sharp price volatility or liquidity vacuums where even small orders can move the price dramatically.
Chapter 6. Risk Assessment.
So we have dissected the opportunity. Now we must focus clinically on what could derail the thesis, framed by a classic SWOT analysis.
Okay, starting with strengths. What are the core internal competencies that provide defensibility?
First, the Optical Interposer IP. It's a patented, validated solution to the industry's biggest manufacturing barrier. Second, the deep semiconductor manufacturing talent provided by Dr. Venkatesen's pedigree, ensuring they can actually execute the RAM.
And third, the robust $300 million cash runway.
Right, which gives them 3 to 4 years of secure execution time, insulating them from any short-term market turbulence.
Now, the weaknesses, the internal limitations they absolutely must overcome.
The biggest internal challenge is that execution ghost. The historical credibility gap stemming from those missed roadmaps. This means the risk of successfully ramping the complex Malaysian supply chain remains paramount.
They have to prove it.
They have to prove it. Also, they face high customer concentration in these early stages, relying heavily on a small handful of partners like Marvell, Luxshare, and Foxconn for that critical early revenue ramp.
Okay, opportunities. The macro tailwinds.
The industry is accelerating directly into POET's highest value area, 1.6T and 3.2T speeds. This is where their miniaturization and thermal density provide an undeniable competitive edge.
And of course, the massive upside potential from Marvell integration.
That could turn POET into the default light source supplier for one of the most critical players in the entire AI interconnect market.
Regarding macroeconomic factors, the sources point out a fascinating paradoxical benefit from high interest rates.
That's right. While high rates typically punish non-profitable growth stocks, POET's massive $300 million cash pile is currently generating significant risk-free interest income around $4 to $5 million annually.
Which substantially offsets their operating cash burn.
It does. It adds another layer of financial insulation.
Now, the long-term threats. What about technological displacement from bigger rivals?
The primary technological threat is that giants like Intel could finally solve the intractable yield issues that have been plaguing monolithic silicon photonics. If they successfully figure out how to make silicon efficiently emit light, POET's hybrid advantage could diminish.
But the fact that Intel is still struggling after billions in investments suggests POET has a long lead time.
A very long lead. But the single most significant external threat right now is geopolitical. Specifically, the risk of Trump 2.0 tariffs targeting their manufacturing base. This threatens their entire cost advantage thesis.
This is a critical deep dive point. POET strategically manufactures in Penang, Malaysia, to avoid direct U.S.-China trade friction. However, the administration has signaled a move toward reciprocal tariffs that could hit Malaysian imports with potential 24% duty on exports to the U.S.
If enacted, that could eliminate their cost advantage overnight.
A 24% tariff is devastating to semiconductor component margins. So how is this mitigated?
There are three layers of mitigation. First is the HTS classification game. HTS code 851C.62.00090 is the technical classification for optical transceivers.
And why does that specific code matter?
Because the U.S. government recognizes these specific foundational AI components are often exempt from broad tariffs, precisely because the U.S. lacks the domestic capacity to meet the high-speed optics demand. Taxing them would be self-defeating protectionism.
Okay. Second is the critical tech exemption.
The administration is intensely focused on maintaining U.S. AI dominance. Industry lobbyists are already arguing that taxing the fundamental components required for AI data centers' optical engines would cripple domestic AI efforts. Analysts expect carve-outs for these critical components, similar to past tariff cycles.
And third,
Pricing power. Given the desperate shortage and high demand for high-speed optics in the market, hyperscalers might just be forced to absorb the tariff costs themselves just to secure supply from a proven scalable source like POED.
so while it's a serious threat that needs monitoring, management has clear, established pathways to navigate it.
They do.
Chapter 7. Conclusion.
Okay, let's synthesize all of these elements. The bull case narrative is incredibly strong. POET is transitioning into the A arm of photonics. They provide the essential architectural glue, the optical interposer IP that solves the industry's manufacturing holy grail.
And that technological superiority has received massive strategic validation from Marvell's acquisition of Celestial AI, confirming POET's role in the next generation of optical interconnects. And fundamentally, they have a financial fortress thanks to that $300 million cash position.
Which eliminates the risk of survival.
Exactly.
Now, the downside, the bear case, centers on 3 points. Execution risk in ramping that Malaysian supply chain, the dark cloud of geopolitical crossfire and the 24% tariff threat, and the possibility that giants like Intel might successfully solve the monolithic silicon photonics problem and displace POET.
So let's bring it back to the valuation summary. We established the intrinsic value range runs from a successful base case of $4.85 to $5.50, up to the full bull case of $8 to $12.
So the stock, at $4.68, is a compelling high beta call option. It is trading below the low end of the base case. This means the market is providing a significant margin of safety via the cash position and essentially throwing in the high upside bull case potential, the full capture of the AI supercycle for free.
It's an intriguing setup for investors seeking exposure to the crucial picks and shovels of AI infrastructure.
It really is.
To leave you with a provocative thought as you consider this sector, if POET Starlight becomes the required standard for Marvell, one of the key companies supplying the chips and interconnects for massive AI clusters, what are the chances that NVIDIA, the dominant force in AI hardware, must eventually adopt or license the same technological solution just to keep pace in the bandwidth race?
That is the core question hanging over the future of light-speed computing. That's all the time we have for this deep dive into POET Technologies. Thank you for joining us.
Like and subscribe to Stock Analytics AI.
For $4.999 a month, get 500-plus deep dive videos on all S&P 500 stocks, with NASDAQ 100 coming next, plus members-only requested deep dives.
Please remember, this analysis was generated by an AI system for educational purposes and should not be considered financial advice. Always conduct your own research or consult with a qualified financial advisor before making any investment decisions.